We had nearly a decade of experimental monetary policies, including $11 trillion of QE by just the top three central banks, the Fed, the European Central Bank, and the Bank of Japan. With QE, central banks create new money and buy assets in the markets for the explicit purpose of inflating asset prices to create the so-called wealth effect, where asset holders get wealthier and spend some of these gains to fire up the regular economy. These policies produced a lot of problems in the real economy and in the financial world too, but they did inflate asset prices wonderfully, and they did so across the board, if not in lockstep, then at least in parallel. U.S. stocks, foreign stocks, government bonds, corporate investment grade bonds, corporate junk bonds, leveraged loans, emerging market bonds, art, classic cars, residential real estate, commercial real estate, startup valuations, they all surged. And then came 2018, which changed everything. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. The date is December 16th, 2018. Since QE and interest rate repression started, just about everything went up together, except gold and silver, which began to diverge in late 2011. Just about every year delivered gains on almost every asset class and investing strategy. All this stuff whose prices inflated together built up risks together, and there was no real diversification possible. This produced a peculiar situation where just about everything was overvalued together, with many asset prices way high in the bubble stratosphere. We call it the everything bubble, and it's global. In other words, just about every aspect of your well-diversified portfolio went up together year after year, which is highly unusual, and which means that there is no effective diversification in your portfolio. Just about the only things that didn't work: shorting the market, holding cash-type investments such as short-term treasury bills, CDs, or money market accounts, or trying to scramble to safety by buying gold and silver after the summer of 2011. But 2018 changed everything. The Fed has raised interest rates 8 times so far this cycle, that started tentatively in December 2015. Another rate hike is likely this week, which would be the 9th rate hike in 3 years, the slowest and longest rate hike cycle in my lifetime. The Fed also started to shed the assets it had acquired under QE. It ramped up its QE unwind gradually starting October last year. It is now operating at cruising speed, and the Fed has shed $370 billion in assets. As for the European Central Bank, the ECB has ended QE as of this month and has put its negative interest rate policy on the chopping block. The first rate hike may occur in 2019. The Bank of Japan has pursued a massive QE program that included all kinds of assets. In 2017, it started quietly tapering. Since then, there have already been 4 months when its assets actually fell from the prior month. That was December 2017 and March, July, and September of 2018. Over the past 12 months, its total assets rose only 4.6% compared to annual increases in 2013 through 2016 that reached 45%. The Bank of Japan targets the entire yield curve, which means it seeks to control short-term yields as well as long-term yields. It owns about half of all government securities and controls the entire government bond market. So it recently decided to give long-term rates more room to inch up, and they have inched up. In other words, by late 2018, the top 3 central banks together have on net started to shed assets instead of buying them, and interest rates have gone up around the world. In this manner, 2018 marks the end of an era, the end of steaming asset price increases, and the beginning of a new era. The U.S. stock market, as measured by the S&P 500 index, is down 2.8% year to date and down 11.6% from its peak. There are some trading days left, and the S&P 500 could yet end up in the green for the year. But so far in December, stocks have just mocked the idea of a Santa rally. The S&P 500, the Dow, and the Nasdaq are all down between 5.6 and 5.8% in December. MarketWatch, which dug into Dow Jones market data, found that for the three indices combined, it was the worst beginning of a December since 1980. The German DAX is down 16% year to date and 20% from its peak. It's in a bear market. In the UK, the FTSE is down 11% in 2018 and down 13% from its peak. Italy's stock index is down 13% year to date and down 23% from its 52-week high in May. In terms of figuring out how far Italy's stocks are down from their all-time peak, we have to go back to 2007. Italy was one of the Euro countries that had experienced one of the biggest asset bubbles, and it collapsed with catastrophic consequences. The asset bubble had been so big that not even years of QE and negative interest rate policy have been able to push asset prices back up to the old out-of-this-world levels. So the stock index remains down nearly 60% from that peak in 2007. Spain's IBEX 35 is down 12% year to date and 16% from its 52-week high. But its all-time peak was also in 2007. Spain too had one of the biggest asset bubbles and it collapsed. Not even the ECB's scorched earth monetary policies have been able to push asset prices back up to the old bubble levels, so the IBEX remains down 43% from that peak. A similar thing happened to other Euro bubble economies that began to collapse in 2008, such as Greece. Swinging to Asia. Japan's Nikkei 225 is down 6.1% year to date and 13% from its 52-week high. Over the years leading up to 1989, Japan had experienced the mother of all bubbles. At the time, it collapsed, and despite the mega QE and 2 decades of zero interest rate policy, the Nikkei remains down 45% from that peak. China's Shanghai Stock Exchange Index is down 22% so far in 2018. China experienced 2 mega bubbles in its stock markets. The first imploded in 2007, and the second bubble, which never quite reached the highs of the first bubble, imploded in 2015. Today, the SSE index is down 57% from the bubble peak in 2007. The act of bubble creation in China has since shifted to real estate and other endeavors, so lots of interesting stuff to look forward to. In terms of the stocks of emerging markets, there is this phenomenon of big inflation which afflicted plenty of countries in 2018, including Argentina, Turkey, and Venezuela. The rise of a stock market denominated in a currency with high inflation says more about the inflation rate than about the underlying companies. So it's better to look at an emerging markets index that is denominated in US dollars, which eliminates the effect of big inflation in those countries. The MSCI Emerging Market Index in US dollars has plunged 22% from its peak in January. In terms of US bonds, their yields have been rising and their prices have been falling. The losses have been massive. We know this from the US banks. They have to report those losses. I just covered this with an article titled US Banks Disclose Biggest Unrealized Losses on Security Investments Since Q1 2009, according to the FDIC. The FDIC released the aggregated third quarter performance metrics of the 5,000 plus US banks and thrifts it insures. They are holding nearly $18 trillion in assets. This consists mostly of loans, but it also includes investments such as $3.6 trillion in bonds. In the third quarter, these banks reported an aggregate unrealized loss on these bonds of $84 billion, over 2% of the value of their securities. The FDIC pointed out that this was the worst unrealized loss on securities since Q1 2009. For the first 3 quarters of 2018 combined, these unrealized losses amounted to $200 billion. Unrealized loss means that the banks are still holding those securities, that they have not yet sold them. So for now, they're paper losses. Banks can hold these bonds to maturity, which is years away. They'll be paid face value for maturing bonds, and there won't be an actual loss unless the bond defaults in the interim. But in a liquidity crisis, such as during the financial crisis, banks can be forced to sell those bonds, in which case the unrealized losses become real and bite. What this example shows is just how much bond portfolios have declined in value. In terms of emerging market dollar bonds, the red-hot asset class last year, the iShares JP Morgan USD Emerging Market Bond ETF, which tracks US dollar denominated bonds issued by emerging market governments and companies, has dropped 14% from its peak in January. Moving on. Gold, unlike any of the other assets I've just mentioned, actually rose 2.5% over the past 3 months. But it's down 7% so far this year, and it's down 35% from its peak in September 2017. Silver is down 13% this year and down 87% from the ludicrous spike in 1980 when the Hunt brothers tried to corner the silver market. Pure commodities such as oil, grains, or industrial metals are really not assets, and they shouldn't be considered an asset class. They produce no returns other than trading returns, and holding them is expensive. They're just commodities to be used. However, publicly traded paper assets have been created backed by these commodities. All kinds of structural issues can crop up that eviscerate long-term holders of these paper assets. Just look at the US Oil Fund, USO, which has lost 90% since its peak in 2008, or the US Natural Gas Fund, UNG, which has lost 98% since its peak in 2008. These paper assets backed by commodities can be fatal for long-term investors. But one commodity I will bring up anyway, an industrial metal that is also a precious metal that you can bury in your backyard, palladium. It's one of the few exceptions this year. It just hit an all-time high of $1,171 an ounce, which is up 8% so far this year. Ironically, it is also up about 8% from its prior all-time peak in January 2001. Yep, barely above its prior peak 18 years ago. The peak of 2001 was followed by an epic collapse of about 85%. The idea, of course, is to ride these metals up and get the heck out before they collapse, which is hard to do. So what has produced gains this year? Housing as an asset class. It's terrible that homes are now being treated as a global asset class, with global investors and Wall Street firms piling into specific markets and distorting prices for people who live there. But in our financialized world, that's how it is. In the US, overall home prices have risen this year, but at a declining rate that looks to be fizzling out for 2019. Housing is local. In many markets, including some of the previously hottest ones, such as the Seattle Metro and the Bay Area, home prices have been on the decline for months, and the losses, given the magnitude of the prices, are large in dollar terms. If the price of a median single-family house in San Francisco declines by 15% from its peak of $1.7 million in early 2018, it means that it's down by $255,000, and that's about what we're looking at. Averaged out into a nationwide figure, home price growth is slowing. From the trends of the past 6 months, it looks like that markets in which prices are still growing will soon be outweighed by markets where prices are on the decline. So, what has done well this year that will likely do even better next year? Cash type investments. This includes short-term treasury bills, high-yield 1-year or 2-year FDIC-insured CDs, high-yield savings accounts, and the like, the safest of all investments. They returned between 1.5% and 3% this year, which sounds like a ludicrously small return after 9 years of bombastic returns in stocks, bonds, real estate, and the total everything bubble. But making 3% in 2019 is a heck of a lot better than losing 10% or 20%. And this is the new era of rising interest rates and no QE. It's the era when the everything bubble unwinds, when the wealth effect reverses more or less gradually, with many wild ups and downs. And we've just had the first foretaste of this in 2018. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you listen to the Wolf Street Report.